it far exceeds mine, so I'm very impressed.
Hey folks, welcome. I'm John Najarian from Market Rebellion, and it is my great pleasure to invite in Jenny Harrington from Gilman Hill, who you've seen, if you've seen us together on the Halftime Report, or if you've seen Jenny on other media with CNBC. Fantastic lady, really great insights. I love getting her letters, which she emails out to her clients, and she's nice enough to share those with me as well. And so let's bring in Jenny Harrington. Jenny, thank you very much for joining today.
Thanks for having me, John. It's always so nice to be with you.
Oh, please. I think this will be fabulous because obviously we're right at a situation now, Jenny, where the Fed has just thrown pretty close to the kitchen sink. I think Steve Leisman, who is not prone to hyperbole, has gone out there and said, this is 3 times bigger than anything I've ever seen them do.
Yeah.
The Fed, that is. And that's a pretty big deal. The fact that the Fed did throw this much at the market today. But before we get to the rest of that, maybe tell us a little bit about, when Jenny's looking out the window and you're seeing ambulances everywhere, right?
Right. It's quite the opposite.
That's what I thought.
Yeah. So it's an interesting perspective that I have because most of my clients are either through advisors, right? Or I work directly with the client. And last night I was at an event in upstate Connecticut with one of the advisors that I work with, and there were 50 clients there and they all showed up. But what I like about that is that I'm very in touch with who I'm managing money for and how they're thinking and feeling and what's going on. So, I got home last night at about 10 and, and the event was really positive. And when I started talking at about 6, futures were up, and then I get home and futures are down 1,200 points. And I'm like, oh God, not again. Like when are we going to turn the corner on this, and how painful is this? And it's scary. I've been through everything. I've been through the .com collapse. I've been through 08, 09. I've been through everything in between then, but it's still scary and it still feels horrible. So what I do is I try to retreat to, answering the questions that I know my clients are asking and addressing how they're feeling. And I also sometimes write letters. I feel like I'm writing them to myself also. So I was driving to work this morning and I, said goodbye to my husband. I'm like, I'm going to go write a letter to clients yet again. He said, what's it going to say? I said, I don't know right now, but I'll figure it out when I start writing. And so by the time I got to work, I titled the note to my clients this morning, A View from My Desk, because I'm sitting here in New Canaan, Connecticut. I look directly across the street at the Metro North train station. As I started typing, a UPS truck drove by. I had just passed the Starbucks where people were hustling out of Starbucks with their coffees in hand, their cars in the parking lot. And it's kind of fun here too, because there's a lot of financial services people who are working from home, but I see them jogging past my window, and I see all the teenage kids who are out of school walking past my window. And my colleagues went out and grabbed lunch, and they said, there's people in the delis and people in the restaurants. And what I'm facing right now is actually that window. So, wall behind me, window in front of me. And there are cars. There's so many people. And I've spoken to and I wrote in the note to my clients, call me. You can call me anytime. That's what you get from me. So I've been on the phone all day with clients having pretty interesting conversations. So I looked out the window and I'm like, you know what? Life marches relentlessly on. It just does. We're Americans and we're resilient, and we are bored with sitting home. And even if we have to, we're just going to go out and take the bull by the horns and keep moving and consuming and growing. So that was the opening to my note to my clients this morning.
Right. And I think it's kind of nice to have that perspective and the calming that was part of it, because that's something that I try to do too, Jenny, when we're talking to whether they're active traders over at Market Rebellion or whether they're investors, and I do think those are 2 different strategies. One's trading, right. One's investing. Boy, the market has been giving the trader types fantastic opportunities, right. And it has been giving the investor types just horrible stomach aches and whiplash because of the ups and downs. And
I want to keep talking. I'm going to grab something off my desk while you talk.
Okay. And I don't think, folks, that you need to change your stripes and become a trader, for instance, if you're an investor. I don't think that any more than I think people can go from being an investor to becoming a short seller. I think these are skills that people develop over time, not something you just throw a light switch and all of a sudden, wow, I'm a short seller, I can do this. I've done both. I've been a short seller. I've been an options or, a leverage trader. And I am primarily a trader. We have people within our firm that do manage money, but I give that job over to them because that's investing. It's not trading. I don't want my broker trading for me. I want him investing or her investing for me. And maybe if you could, Jenny, by the way, since I've never asked you directly, what sorts of clients do you have? I mean, are these primarily institutions and endowments? Are they also high net worth individuals? About how does it break down?
They're mostly high net worth individuals, whether they're coming to me through an institutional advisor or whether they're coming to me directly, and because they're self-directed, they're almost all individuals. And they're all very long-term focused. And I think it's interesting the way you were talking about it, John, short-term trading oriented or long-term investment oriented, because so much of that, they're both equally viable and wonderful places to make money, but you need to know what you're good at, right? And I know that I'm not good at guessing what's going to happen. Not guessing, I'm not good at assessing what's going to happen in the next day or two. That's just not my skill set. But what I am really, really good at is being able to look through distress and look through markets. And for me, for better and worse, I don't get riled by things, right? So a market like this, what I was looking for before is I have this bumper sticker that says, I love volatility. And, and I do because volatility creates opportunity. And that's for both the shorter term traders and the longer term investors. But so all of my clients come to me, and when they work with me, one of the things that I'm really, really conscious of putting out there to them is, if you work with me, we're looking 3 to 5, 10 years ahead. And that's how this works. And because I manage this dividend strategy, you're going to get this much money this year from income. You're going to get that much the next year. You're going to get that much the next year. The market value is going to fluctuate. It might fluctuate a lot. But if you're going to work with me, we need to tune that out because we're totally focused on the long run. So this is a quick aside, but I'm a rider, a horse person. And I think one of the things when you're riding, when you're learning to ride, the trainer always says, look between the horse's ears, keep your balance and look between the horse's ears, because the horse will go where your eyes go. And I actually always think about that with investing. Cheesy, I know. But you need to keep your eyes up and focused on the horizon and at the long run, and you need to keep your balance while you're there. Because if you're looking, and I think you could probably apply this like any balance-oriented sport, but if you're looking up to the side, down, everywhere behind you, you're going to fall off. You're going to fall off whatever you're riding, whatever you're going to do. You're going to be a rotten athlete. And I think this is the same. You look forward, you know where you're going, you know what your skill set is, and you stick with it, and you keep your balance throughout, and you just, I don't want to say like repress your emotions, but I think you kind of repress your emotions in a time like this.
Yeah, I think emotions can be something you want to fight against in times like this. I couldn't agree more. We saw a massive amount of puts being bought yesterday, Jenny, in the HYG, which I don't know that you ever trade this for clients, but it's basically the high yield corporate bonds.
Yeah.
And they were buying like crazy yesterday. They bought over 1 million put contracts yesterday. And I'm just going to pull it up for myself here to see where we bottomed out in that today. I'm not saying it's the all-time bottom for it, but yesterday it closed at 80.84, and today it traded down to 76.23. And this is a bond ETF.
Yeah.
Granted, it's high yield bonds, but corporate high yield bonds, but nonetheless, that is about as dramatic as it gets in this market.
Yeah, I mean, unless it's about as dramatic as it gets, unless you look at closed-end MLP funds with leverage, and then they make that kind of move look like chump change. Those are really moving in a crazy way. So high yield, I think, is an interesting thing, and this is where I'd rather own individual bonds than a fund, because even in the high yield space, I think broadly it's probably being painted with the correct brush, which is high yield is going to have a lot of pain. But at the same time, I think there's still tons of opportunity to buy individual bonds that are categorized as high yield right now, where it's actually a really high quality, high cash flow company where that bond might be completely safe. But the opportunities are created when the funds get painted and thrown out, and then they eventually sell, and then all the bonds get priced accordingly. So I think it creates a ton of opportunity, maybe on the individual bond side, rather than thinking that you need to go long HYG at some point.
All right. Well, let me ask you, if one of your clients calls at the end of markets today and says, okay, so the Fed pumped 500 billion in short-term funding,
Yeah.
the New York Fed, that is, that you guys know the headlines so far. Obviously, we recovered more than half of the initial drop because we were down 2,200 points in the Dow. Then we, after being down only like 600 points or so, we have fallen back to being down about 1,400. So my question, maybe one of your investors' question would be, is this a bottoming process and the Fed is helping to get us to that bottoming process? Or was this just, like somebody running around with $100 bills setting them on fire?
I think it's definitely the bottoming process. And in this meeting last night with clients, one of the guys was pushing me, is it a V or is it a U or is it a flat? And, I always say, like, look, we have no idea, but it feels to me like it's a bump along kind of bottom. It doesn't feel like we're at the V inflection point, and it feels like we're bumping along there. And I think that's because there's a tremendous amount of information to process, and it's information from the Fed, it's information from the ECB, it's going to be more information as it comes out on the virus and who's infected and what the death rates actually start to look like. But there's so much information, and there's ambiguity in a way on this that I haven't dealt with exactly before. It's different every time. But because there's such a human element to this, it's not like we can just look to 2018 and say, well, here's what happens when there's China global growth scares, or even 08, 09 with the financial system collapsing. There was no precedent for that, but somehow that was more contained in our own little world, where this is spread out to even my kids are affected right now. They're home from school. So I think it's a bumpy bottom. But I think we're there.
Let me ask you this then. Yeah. Actually, this is from at ROBY.
Wow, Robbie.
So what that person, I'll assume it's a guy, but it just as easily could be a woman. No, actually it was somebody else. Sorry. It's the questions are rolling by fairly quickly. But the statement that was made here was stocks are still ridiculously expensive. I push back on that like crazy here.
I'll double down on your pushing back on it like crazy.
Okay, please do.
Yeah. So this morning, I haven't bought either of these. I'm not sure if I will, but this morning what's on my screen is, and that have crept up over the last week or so, is like UPS and Cisco. These things are trading at 11 times. There's still a cohort of stocks out there that are trading in the 27 plus multiple, right? Like Amazon's still at about 75. Netflix is still in the 80 range. Facebook, Microsoft, they're all still like high 20s to low 30s, I think. But what's in my portfolio is like 11 times earnings. And there are a ton, once you carve out the top 10 or 20 stocks in the S&P 500, that other 490, they are cheap. Not all of them, but a ton of them are cheap. And at valuations that I've never seen some of them trade at. So just another interesting thing, every Monday morning we run a screen of all the companies in the US with a dividend yield above 3.5%, above a market cap of 100 million. And that screen always ranges in the 330 company range. 123 new companies were on that screen this week, which is wild. But it's also a statement on how compressed valuations became in the last week. So yeah, I'm going to push back on that too. Just
all right.
Oh yeah.
Well,
sorry,
for instance, when I'm looking at it, Jenny, and I know not everybody uses things like CAPE ratios or whatever, but when you're talking cyclically adjusted price to earnings, the peak before the 07 crisis was for the MSCI, in other words, very broad swath of stocks, was 26. This morning, I believe it hit 13.
Wow.
So I don't
know it was that dramatic.
How somebody looks at that. And this is from Odd Stock Jockey, I guess. No, OCD Stock Jockey. Thank you, OCD Stock Jockey. Because there are no dumb questions or statements. I'm just figuring when I look at it, it looks cheap to me.
Yeah.
I believe Mark Cuban, Jenny, said that on the halftime report today too. And we don't know if we're going to keep bumping along and for how long we're going to keep bumping along. $500 billion here or there, pretty soon it adds up to a pretty substantial exhaustion of some of the panic selling. But I'll throw another one out there at you, Jenny. The CME announced yesterday after the close that they're going to be closing their floor after trade tomorrow. Not forever, but for some non-specified amount of time.
Yeah.
To keep large groups of people away from each other, to keep this from spreading. I understand. And they have a Globex platform that allows people to trade 23 and a half hours a day anyway. So the one thing I worry about though, Jenny, is the more human beings you take out of the equation, the larger the price swings get. We've already seen that as we took more and more traders, intermediaries, if you will, makers, not just takers, out of the market. Things can move pretty fast, and no greater example than the last 3 weeks. I mean, the speed of this drop has been incredible. Speeds of rallies as well as of sell-offs. So my posit, or my thesis, I guess, is that we are probably not out of the woods on this because of, as you said, more headlines, which will include deaths as well as that denominator I talked about. In other words, the more we know how many people are actually ill with this virus, unless we see a hockey stick of the number of deaths, which I don't think we're going to see. We didn't see it in Japan or South Korea. Can't trust what we hear out of China. I get that. But those other two did not have a hockey stick for the number of deaths. They did see hockey sticking of the number of the denominator, the number of illnesses. But we're going to have to keep our eye on that. And until we get to a place where all of a sudden, instead of being 3.4% or whatever it is, are resulting in mortality, all of a sudden we get down to 2 and down to 1. I think that'll be a dramatic turn in the market at that point.
I do too. And it's just, it's how much it's the pace with which information becomes available. So one of the things that I wanted to put in my client note, but it got edited out because it sounded too cavalier, was that in a weird way this morning, I was feeling a teeny bit optimistic, more optimistic than I've felt in a week, because this is me looking through things, but at least we're starting to see things happen, right? So now as a mom with 2 kids, I'm not sitting here being like, are they going to cancel school? When are they going to cancel school? Okay, it's canceled. It's done. It's over. And so as there's just more and more of these events, like the NBA thing, it's terrible. It makes me feel sick. But you know what? It's happened. It's done. Colleges, they're all canceling. They're done. It's terrible. It's bad for society. It's bad for humanity. I mean, in terms of psychology, it's probably good for the stem of the virus. But it's done. So once these things are done, we have the information. That's one big part of the information. We can take it, we can digest it, we can start to move on. We can think about how people's habits really aren't going to change. We'll see our students sitting home and they're watching ever more Netflix and they're ever more online and they're actually bored, so they're online shopping, which would support the UPS thesis. But once we see how things really play out, it's going to diminish the uncertainty. There's, 3 days ago there was this much uncertainty, right? And now there's maybe this much uncertainty left. So with each new terrible thing that happens, at least it's information. And I think that's what we crave.
Right. And now we've got the NHL saying that they're postponing as well.
Yeah, they're all going to do it.
Sure, they are. And the PGA, I believe, has said that they're not going to have fans on the golf course, that the golfers will be out there without fans for some period of time.
Yeah.
Again, these are the sort of draconian measures that you expect if indeed you're going to corral this thing and keep it from jumping from person to person in large groups. And I think it was, it was Karen Firestone yesterday from Boston, Jenny, that said, we're probably going to have a treatment. Scott pushed back and said, we're not going to have a vaccine for a year. And she said, I didn't say a vaccine. I said a treatment.
Yeah.
Because they're experimenting with a lot of them. Gilead, a stock that I own, is at the forefront, or at the center at least, of a lot of those, because it's probably going to be a cocktail, meaning, as you guys know, cocktails like a mixture of several drugs to achieve some end result that's going to arrest this virus in people that have it, rather than just keeping people on ventilators, because that's one of the issues with this, is it affects their lungs so dramatically that they have to have them on ventilators. So getting them off ventilators so they can get enough oxygen in there is key. And if something can arrest this, then I think we'll see a pretty dramatic jump. But moves like this by the Fed, and speaking of moves, what did you think of the move out of Christine Lagarde and the ECB, Jenny? Was that enough?
I don't know. I didn't have a hugely strong opinion on it. I was a little surprised that they didn't cut rates too. Like I thought they'd really just shock on that. So I was a little surprised there. But I have a lot of faith in central banks to have more knowledge than I do and to do what they think is right at the time, as well as keeping, some in reserves for later if they need it. So I'd like to believe that they did what they thought was right at the time.
Yep. And they have to drag the Germans in kicking and screaming.
Right.
Because they didn't want to go to deficit spending until they had to.
Just one quick thing on you talking about Gilead and the cocktail of drugs and everything that's going on. One of the things that I actually put this up on Twitter today, I said the word of the day is indiscriminate. I'm sitting at my desk and I'm looking at AbbVie, right? And I'm looking at Pfizer, and they're both down, or they were down earlier, about 8%. And it's just crazy. There's no version of what's going on that's negative for those companies. Whether they don't have what Gilead has, they're not at the center of it, but they're not negatively impacted in any way whatsoever by this. Yet there's this indiscriminate selling. So just getting back to our very, opening thing and valuations, there's so much opportunity that comes from this. And I know it's a little callous to talk about opportunity in this kind of environment, but as an investor, as a trader, there's so much opportunity. It's very exciting. A real quick aside, one of my clients, in my note, I said, call me, and a bunch of clients did. One of my clients who I've worked with since 1997, who's a professional trader, and then he's a professional trader and I manage part of the investments, right? But he called me, he's like, hey, I bought Mr. Softy this morning. I put money to work. I bought a few stocks. I bought Mr. Softy, which is Microsoft to him and to many others. So people are putting money to work. And then I have another client who called later who I answered the phone. I said, are you going to jump out the window? And he's like, what? No, I'm fine. I'm okay. So I just think it's interesting how some people are handling this as opportunity. I have another client who called before and said, I just deposited some more in my IRA, put it to work. There is some group out there that's thinking, I think, very rationally and looking at this as an opportunistic moment with these crazy valuations and the unhinged behavior in some of the stocks.
Well, one of the strange things that happened today, Jenny, at least it was threatened, and it ended up coming to pass, was that the Merck, as I say, they announced that they're going to shut down on Friday after the close. Friday the 13th, by the way, folks.
Yeah.
The CBOE has not announced, at least as of this moment, I haven't seen that they've announced that they're shutting down. But the specialist for the VIX announced that they were not going to be on the floor. They were going to be making markets electronically, not down there in the pit today.
So John, you know this world so much better than I do. How significant is that really to not have the human body sitting there trading the VIX from the floor? Like, how much can the specialist really transact from a remote location?
Well, like I say, I think it exaggerates the moves, Jenny, because now this is one group. There are still traders on the floor for a S&P 500, for the quad or the triple Qs and the VIX options. But the more people that there are that leave the floor, one of the best things about the floor is the shared information that you can see orders coming in and people
even
can react.
Still.
Right. Even still, even now. Yeah. And they're the last surviving pits. There is no IBM pit anymore. There is no Microsoft or Dell or any of the others. Yeah, they have a sign down there, but there's nobody there.
Right. I've seen that.
So the VIX, though, there are probably, last count yesterday, I'm going to say there are probably 40 or more traders in the VIX pit, and they all have computers, and they're standing and some are sitting, and they have, 4 monitor setups, just like most of the traders listening to this have. And they're reacting, though, to a collective of information that's happening in that pit. Whereas once you go upstairs, sure, you can duplicate it. You could have all those guys on Skype.
But
and
it just doesn't work.
Right. Yeah. But chances are it's still going to be disjointed, and you're going to see more wild swings
Yeah.
because of that. That's my opinion.
It's funny. The client that I spoke to this morning, the one who bought Microsoft, who had been a professional trader, he was lamenting the demise of the specialist. And he was saying, look, if specialists were still empowered or en masse the way they were in the 90s when I worked with him, this would be such a different response and emotion, because you'd have that human stopgap going in and making functional decisions in a way that's unavailable today. Do you think that's a fair statement?
Yes.
Yeah.
Yep. I think now, I could have a contra to it, but instead I'll say, I think that's true. The fewer intermediaries that there are, the more exaggerated the moves will be.
Right.
And then as many of them react, seeing a big order go up at a price, many of them will start moving price very dramatically in up or down direction, depending if it's
Right.
calls or puts. And so I think that's going to play out, Jenny. Again, to your point about maybe more of a U-shaped bottom where we're putting in
Bumpy bottom.
a bumpy bottom. I have to say that that's more what I'm looking for now, both because of that numerator versus denominator issue on the cases of COVID-19 versus mortality of it, as well as the more we take people off the floors, the fewer intermediaries. I think that's going to mean that we have more violent moves.
Right.
Might
Violence
take us
is really the
2 or
right
3
word.
weeks.
Do you think so? One of the things that I've been thinking through in this situation is how, with every good disaster comes, global improvements. So I think one of the things we'll see is that this has tested the fragility of global just-in-time supply chains. And I'll bet you we look back and we see in 10 years that global supply chains have become more resilient, more flexible, more outsourceable, maybe more diversified, but they're more resilient. Do you think that from the way that trading's been happening in the last, this is really extreme in the past 10 years. Do you think there's ever a return of the specialist in a sizable way, or you think we're in this more computer-driven environment forever?
I could come up with scenarios where I could see a specialist coming back, but it would probably be, Jenny, temporary, even if it did, just because of the economies of when everything's on a screen, it's a lot cheaper. So that's one of the reasons, like I said, that, when the Merc takes a look at exactly what happens during their, let's say it's 2 weeks that they shut the floor down. When they look at, okay, we know how much it costs us a month to run electricity. You've got Globex running at the same time anyway, as long as we can handle the throughput on Globex. Do we need all that electricity for heating, for air conditioning, for security guards, for everything that goes into supporting a floor? When in fact, you've been with us on the New York Stock Exchange.
Yep.
The New York Stock Exchange is, for the most part, a stage. It's a backdrop for CNBC and for, Cheddar and Fox.
And for the specialists to bring their clients for a cool tour of something iconic.
Yep. So, we don't really need them. There will be some that would survive just so that they can do exactly what Jenny mentioned, folks. Some, especially like the New York Stock Exchange, that charges listing fees. Most of the exchanges that I have been associated with do not. Most of those can just list whatever the heck they want. You don't have to pay Microsoft to list Microsoft options. You don't have to pay OPEC or the Permian or anybody else to list oil, like the CME owns virtually. CME and the ICE that owns the New York Stock Exchange, they own the oil contracts in the United States. So they didn't have to pay anything for those. Those are just contracts that they've created that don't have listing fees, so they don't need a visitor's gallery to go down there or a backdrop for CNBC. So I think that's unfortunately the way of the future still. I don't think you'll see a comeback of specialists, Jenny.
Yeah, one of my earliest experiences was I joined Goldman Sachs in 1997, and I was in private client services during the Asian debt crisis. And so one of my early experiences was the market down 800, right, which seemed like an incredible amount, and being unable to get trades in and running them up. I think I was on 39 and I had to run them up to the 40th floor where trading was. I might have the floors off, but running it up and getting reports back wildly off hours later. So it's a little bit of a love-hate with that. In some ways, you wish you had that back, so there are the human layers of circuit breakers that intervened in this kind of environment. In other ways, it's so nice and so wonderful that even though we don't have that, we put a trade in and we get the execution like that. We know where we stand. The technology's really improved, but I do miss a bit of the human element. Bringing some moderation into these wild swings.
Well, Jenny, I really appreciate your time. I'm going to be
Thanks, John.
grateful to you as well as respectful of your time. So thank you for sharing those
Thank you.
insights with us today. I'll make sure I post a link to you as well because we'll put up the recording of this, folks, not just the live stream, but we appreciate all of you joining in, and shoot us a bunch of questions on Twitter. I'll put up Jenny's handle as well as my own and make sure you respond to it. So thank you, Jenny.
Thank you, John. It's always fun to be on with you. So thanks.
All right.
Thanks everyone for listening.
Thank you.
Bye-bye.